So we're doing the third of our Around the World webinars, and this week it's Asia. And I'm delighted to be with the managers of Aberdeen China and Aberdeen Japan Investment Trusts, and Nick Wood from QuotedData. So welcome one and all. And the title of this was China versus India. We're slightly hamstrung by this because the manager we had lined to talk about India actually had to pull out at the last minute. But I'll be sort of trying to cover that sort of angle of things. The reason I thought it might be interesting is because in terms of population, India is catching up with China. So there's actually only a smidgen in it now. India's got 1.3 billion people against China's 1.41 billion people, and it's expected to be overtaking it in a couple of years. But in terms of GDP and GDP per capita, it's only a fraction of China's. It's about sort of a fifth. And the demographics have actually changed quite dramatically. So China's now aging quite rapidly, whereas India's population is still expanding. So it's got an expanding workforce. What India lags in is in terms of the infrastructure that it's got, because China spent a lot of money, especially in the 90s, just improving its infrastructure, and is still spending money today and bring everything up to date. And that gives it an advantage, sort of reinforces its ability to grow. So China's got 10 of the world's 100 largest companies by market cap against India's 2. So it's got quite a long way to go to catch up. But forecasters are still saying it is possible, so we'll just have to try and explore that a bit. But since we've got a manager from Japan here, I thought we'd look at the wider kind of Asian story and how that might impact the whole region. And Nick's here as an investor because he's got quite a lot of money, important clients' money invested in this sort of area of the world. So I think it'd be interesting to get his side of things as well. And maybe we start with you, Nick, and you could just tell us how you actually go about accessing China and India within your portfolios.
Yeah, certainly. Thanks, James. Thanks for inviting me on today. So QuotedData, just as a background, a large wealth manager. I head up the fund research team there. And, it's fair to say the majority of our assets within China and India still today sit within either broad emerging markets funds or Asia funds. And Asia funds these days, I'm sure many listeners will know, emerging markets, really 70% of that is Asia. So it's a combination of those two, and investors have long had reason to be sort of more excited about the stories in China and India than, for example, in Australia, for example. So we get a lot of our exposure there. We have of those two regions, China is the one where we're looking at more dedicated investment, so specific China managers. India, it's fair to say, I think is still the vast majority of our investments will be via those Asia and emerging market countries. I think China is the area where specific investment resource and actually the balance between on and offshore investments, that's really the growth area in terms of specifics.
And I think you go back to when I started investing in the sector many years ago, it was quite common to have pan-Asia funds, including Japan. Actually, I think Aberdeen Japan came out with one of those. So that kind of changed as Japan became such a big part of the Asian economy, had its own kind of dedicated funds. Do you think that might happen now with China?
Yeah, I mean, that's definitely the way we're going. And yeah, I mean, it's interesting. Yeah, Pan-Pacific funds. I mean, I think there might be the odd one around, but certainly not many. What I'm beginning to see, though, is the launch of EM ex-China funds. So we're certainly beginning to see a number of them, early discussions. I suspect those that are launching, let's launch the fund, let's get a track record in that space. And personally, I think 3 or 4 years time, that's when it'll really sort of become a more significant point. And we're talking investment trusts today, and if you think about even the investment trust space, the number of China funds, I mean, until recently there were as many Vietnamese dedicated funds as there were China funds. That's beginning to change, but I mean that gives you a really good content. I always think, you know, the investment trust space tends to be a little ahead in some respects in getting those things out there. So we're definitely moving that way, but we're in the early stages of EMX China. But I don't doubt that will come to pass in due course.
So, Elizabeth, do you invest across the whole of China, both in local companies and in foreign listed companies?
Yes. So when it comes to investing in China, we while we have some, you know, onshore specific open-ended funds, on the whole, when we do our research and our portfolio allocation, we look at China as a whole. You know, whether it's listed in Shanghai or Shenzhen or in Hong Kong or in the US, it doesn't really matter to us because the business is the same at the end of the day. The way we analyze the business, the management, it's all using the same framework. So I think there are, you know, small nuances in terms of the markets themselves. So for instance, onshore markets might be a little more retail investor dominated, and as such, you know, can be more volatile when it comes to sentiment. But on the whole, when we look at, you know, China, we definitely don't want to exclude any part of the universe, because what you get onshore, you cannot always get on offshore listings. So for instance, you know, the big names, Tencent, Alibaba, they're not listed onshore in China, and on the other hand, you know, smaller or even large domestic players in the, you know, Baijiu space, the alcohol space, they can only be found onshore in China. So we definitely don't want to be missing out, and so we look at, you know, both on and offshore.
And to you and both you and Hisashi, how important is it to have sort of a local presence to actually be in the country that you're investing in, do you think?
So I think for China, it's definitely important in the sense that, you know, at least at Aberdeen, we very much focus on first-hand research. So it's very difficult for us to just, you know, simply read a sell-side report or newspaper and then decide to buy in a company. You know, it's such a big country, so many types of people running businesses. You want to be sure of what you're investing in. It's not always possible, and also, you know, a lot of the times we want to be ahead of the market. So we don't want to be, you know, buying after everyone knows about a stock or a company. So in that sense, on the ground research is very important. And when it comes to you know, management and track record, it would be, you know, most ideal if we can meet the founder or the CEO in person. So that's very important. And I think going on the ground to do site visits, it also helps us in terms of idea generation. So, you know, a big name might be covered by, you know, many analysts, but if you go on the ground, you do a tour, you get to see all the peers, the supply chain. That's also a great way to find new ideas for us.
And is that true in Japan as well?
Yes, very much so. And, you know, on the point about site visit, we also find that very useful. I mean, these days there's a bit less maybe doing site visits online, but it's fascinating when we go visit these plants. You know, you go talk to some of these employees, and it's some really high quality companies, well-run companies. You know, they're saying everything, the same thing from top management to the sort of the, you know, employees you talk to in the plants. They all have share the same philosophy. When we're talking about refinement, and it's small things such as how clean the plant is, and you know, how well that philosophy is shared between everyone within the company. So we found that quite useful. And another thing I'd add is that one of the things that we believe is important is you know, investing in the company, just the beginning really of that journey. So when I spend time speaking to the management teams, engaging with them, and for that purpose, it's very important that we have that you know, we develop that relationship with management teams. So in that sense, local presence is very important, and we actually talk to management teams or companies on a daily basis, not just to ask about what's happening on the ground, but also to engage. So from that perspective, yes, it's very important to have that local presence.
Actually, it brings you on to sort of another topic, really. So Nick, how important do you think it is that these managers are engaged in the kind of environmental, social governance, ESG aspects of investing?
Yeah, I mean, it's critical to our assessment of every manager these days, you know, and certainly, you know, if I take China, I think, you know, one of the first questions that a lot of investors have when they're investing in China is exactly around ESG and all three elements of that. Actually, you know, there are plenty of areas to dig into there. So as a fund selector, you know, that will be a key part of the discussions we have. It's interesting. I mean, we've got a Japan manager on today, and I think Japan's an interesting area. I think that's one of, you know, Japan is one of those areas where I think you know, ESG is understated. I certainly hear lots of discussions where managers and you know, we might hear this today, you know, smaller companies who aren't filling out their MSCI forms in English and get a lower ESG rating. You know, there's a good story for ESG improvement, I think, in Japan. Across to China, across to emerging markets, really it's ensuring that, you know, that the right work is done, that that you are investing with eyes wide open. You have properly assessed some of the potential issues and materiality. So absolutely front and center for investors like me, and I'm sure among our peers.
Elizabeth, do you actively sort of screen out companies that aren't prepared to engage with you?
Yes. So, you know, when it comes to ESG, it is one of the 5 key criteria that we look at. So we follow a quality investing philosophy, and in that definition of quality, ESG is one of those 5. I think, you know, how willing a company is to engage with us is a key indicator of quality. If at the very beginning, if they're unwilling to, you know, even meet with investors, that's not very good sign to begin with. So, you know, when we talk about ESG in China, it's impossible for every single company to be a leader at this point. So, you know, you have to be quite realistic. But I think what we're looking for is companies that are, you know, relative leaders and that are engageable. So, we call ourselves not just investors, but engagers, in the sense that if we buy a company, we can, you know, work together to identify areas for improvement, and, you know, how receptive a company is to that is a good indicator of quality. And in many of our portfolio companies, we have seen that over the years, those that are willing to engage actually have very good outcomes. In terms of, you know, us believing that ESG issues are financially material to them, whether in terms of, you know, improving returns or even, you know, just simply avoiding penalties and fines. You know, working together, you know, they also want to learn from us. So I think, you know, it's been quite positive so far from what we've seen in China. I would say that 5 years ago, what Nick just mentioned about, you know, disclosure or not filling out their MSCI form in English, that was, you know, kind of a challenge. But I think we've gotten past that for the most part. And so, yeah, I think things are moving in the right direction for companies in China.
Great, thank you. And Hisashi, in Japan, we've actually got a couple of dedicated corporate governance funds listed in the UK, investing in Japan. Do you see opportunities? I mean, they seem to be buying things for less than the value of the cash on the balance sheet sometimes. Is that the sort of thing that might find its way into your portfolio?
So in terms of our fund, we're very much quality focused. So we are investing in quality companies, but a lot of times these are, you know, some of the best in class companies in their own fields. You know, they're just niche companies. Nick mentioned earlier some of the smaller companies, and operationally speaking, they're already best in class. But when we go and talk to them, there's room for improvement in terms of ESG. And just something, just to give an example. So we invest in this paint company that has operations not just in Japan, but emerging markets, a successful company in its own field. And one of the issues, they just went for scale in the past and doing these acquisitions and not really focus on profitability. And it just and really they have the technology, they have the distribution, but they just weren't focusing on profitability. So, you know, we went and talked to them about improving profitability, restructuring, focusing returns, and you know, now they actually, the stock has during the journey, stock re-rated. So something like that we find as opportunity. I mean, it's even for these well-run businesses, we believe that there's room to improve, and operationally, or in terms, it could be disclosure, it could be a better focus on returns, better focus on money to shareholder interest. So there's it comes from low base in Japan, but it also means that there's actually a lot of upside in terms of room, in terms of incremental improvement.
Cool, thank you. If we think about some of the other big things that have been impacting markets recently, I would start maybe with COVID, because India was one of the countries that I suppose struggled maybe more than others. I mean, they had initially quite a severe lockdown that sort of knocked the economy, big dent in the economy, and then second time round didn't lock down and actually had an awful lot of cases and deaths, unfortunately. But the way that both Japan and China have approached it has been quite different. So how has that impacted your markets? Maybe we start with China first, please.
Yep. So China is, has been and continues to follow their zero COVID policy. So obviously that means that wherever there's an outbreak, there is a lockdown. So I think if you look back to the start of COVID, before everyone really had any idea what was going on, the lockdowns were very much nationwide, very severe. If there was a case anywhere, the whole province might be locked down. Fast forward to today, they're still following this zero COVID strategy, but I think that generally speaking, it's much more targeted. So they try and balance the the need for a lockdown with the economic ramifications. As you probably saw, growth in the second half of last year was not as high as it was prior to that. So growth is definitely a priority on the minds of the government and policymakers. So I think everyone's aware that this zero COVID strategy cannot last forever. They have acknowledged that. And there's some speculation that the reopening might happen perhaps next spring, which looks like a reasonable timeline, assuming they want to get past the 20th Party Congress later this year, and as they get more effective drugs and vaccines going. So I think it does cause volatility from time to time, in the sense that if there are cases, there's a sudden lockdown and people cannot go to work or factories have to shut down. So we definitely have seen that kind of volatility. It's not as bad as it was at the start of COVID, but we're hopeful that as things move along, then eventually they will start to open up as well.
And in Japan, initially it was sort of slightly criticised for the pace of vaccinations, and then in the run up to Olympics, things started to really ramp up. So what's the situation there with COVID now?
Yeah, so we just had the 6th wave of COVID with Omicron, and there are now signs of that peaking. And at the same time, the 3rd booster shot that's been ramping up. So I'm actually, I had my 3rd shot just a couple of weeks ago. So after a couple of tough years, Japan is sort of, there's expectation that, obviously it's been stop-start, but the expectation that it's sort of returning to normalcy after tough periods. And once we come out of that 6th wave, there are signs of consumer sentiment picking up as well. So it is also, we are also eyeing reopening ahead. Of course, we need to be cautious given what we've seen in the past, but at least the in terms of the mortality rate and so on, it has been contained, and there's also money to be spent as well. So yes, we believe that the worst is over, and there's that sign to normalcy. It's a mild recovery, but the sure recovery.
Oh, good, thank you. Now, another sort of a big thing at the moment, which is being exacerbated by the invasion of Ukraine, is the sort of soaring prices, especially for energy and commodities, but that's sort of feeding through into much higher inflation everywhere. Nick, maybe first, is that something that you're quite worried about in your portfolios?
Well, so if reflecting on sort of some of the views of the the managers we own. I mean, a couple of points to make. India is higher oil certainly has a potentially negative impact on India, and so it's interesting actually. Broadly, what we've seen in terms of relative investment in India is some significant increases sort of post 2020 when the market looked quite cheap. I think generally now market looking a bit more expensive, and actually higher oil price specifically being a negative for India. I think certainly we're seeing some selling there. I mentioned at the start around Asia managers generally are more likely to be buyers of emerging markets. I mean, it's quite interesting at the moment that where might you see some of the beneficiaries of this? Actually, Australia, which actually a lot of Asia funds don't will avoid altogether. But by the definition of their universe, or just because they see interesting opportunity elsewhere. Australia has the banks, it has the commodities, so potentially that's depending on exactly what your index is or your universe. That's an interesting shift. And for China, the concerns generally around there, I'd say less. COVID clearly is one of those broad factors. I mean, we've had our managers have been more concerned about Xi Jinping's sort of universal prosperity reforms and the impact that might have. And on the one hand, that certainly impacted a number of specific kind of companies. On the other hand, lots of discussion about, well, maybe this is good for the Chinese economy generally. Concerns around property. I think in China you saw the producer price index move up quite significantly the other day. So I wouldn't say that in China specifically, that's necessarily the key driver. But that sort of gives you a general set, maybe two or three of the markets where I think it is relevant.
Elizabeth, you're sort of focused on quality. Does that mean that you've got investments in companies that actually can pass on price increases? Is that one of the sort of benefits of that focus?
Yes. So apart from ESG, which I mentioned earlier, some of the other quality criteria that we consider are firstly the competitive advantage or the economic moat of the business, as well as attractive industry characteristics. So that's exactly right. What we hope to look for are companies that can, first off, that they have some pricing power. They're not just price takers in the market. And they have a moat. So whether that be in distribution or in their brand equity, or their just their operational management, what we're looking for is companies that can pass through these cost pressures to defend their margins. We saw that throughout the last year. So we've had bits of inflation here and there, cost pressure. And many of the companies that we own, for example, some names, Staples, some of the condiment names, even through that period, they were able to announce price hikes. So that's a good indicator for us that they can defend their margin even in this kind of environment. So yeah, that's definitely something that we look for.
And Hisashi, I suppose Japan is another importer of energy. Is this a concern for you that it's going to drive up inflation in Japan, or actually maybe they're a good thing?
Yeah, so I mean, Japan has seen many years of deflation. So finally, there are signs of inflation. It is picking up with the cost increases, but at the same time, what we're seeing right now is these corporates raising prices for the first time. Sometimes in first time in a decade, and it's everything from soy sauce to rice to you name it, and it's actually, we're seeing that signs of companies changing stance really. In Japan, these corporates have in the past may have been reluctant to raise prices, but on the back of this recent cost inflation, we're seeing that. So there is that willingness to pass through that cost. But of course, what's important is the pricing power. It's very, very much something we look for when investing in companies, and we do see that happening. So for example, some of these high tech companies that are investing, Advantis, for example, is a semiconductor equipment company. They make these testers for leading edge applications in semiconductors, very high end, and you know, it's relatively easy for companies like that to pass through costs because it's very high end, and the product they provide is actually quite high value add. So it's essential for customers, and in many cases, you know, they are number 1 or 2 in the world. So there's that pricing power. But we also see that on the consumer side as well, it's actually good to see that that change in companies' attitudes towards raising prices.
Good, thank you. And in terms of the sort of energy component of this, I just wondered to what extent your portfolios are exposed to renewable energy. Maybe Elizabeth, have you got anything to solar and wind and that sort of thing?
Yep. So, you know, in terms of renewable energy, going green is one of the key investment themes of our investment strategy. You know, China has been quite an early mover in this space, you know, before it became, you know, all the rage these last 2 years. So if you look at the global supply chain, China actually dominates the wind, battery, solar production. You know, over 90% of solar market share globally comes from China. And, you know, initially these industries are very heavily subsidized by the government, but they've reached a stage where that no longer needs to be the case. So we've actually managed to find quite a number of good investment opportunities in renewable energy. For instance, when it comes to EVs, you know, one of kind of major player is the largest battery maker for electric vehicles. They supply to Tesla, they supply to domestic players. So something like that is a great investment for us in the sense that we are able to play this EV trend without taking on any specific brand risk. You know, they have the scale, they have the cost advantage and the technology. And then we do also have exposure to, you know, the solar value chain, the wind value chain. So a lot of the times we don't necessarily, you know, just buy solar farm or wind farm, but, you know, looking into their value chain, that there's a lot of interesting opportunities. And it's something that we see is very much aligned with the government's policy objectives as well. So that always helps. China has the goal of being net carbon neutral by 2060. It's a directive from the very top. So there are quite a number of good opportunities out there.
And is there an opportunity in Japan as well?
Yes, very much so. And it may not be so clear because, you know, if you look at, for example, wind power, there are many you know, world-leading or such well-known Japanese companies. But when you look at components and some of these energy-saving or energy-efficient technologies, there are a lot of Japanese companies, and I suppose it's really out of necessity in the past that with lack of natural resources, you know, there was that need to really try to be energy efficient and improve, for example, improve fuel efficiency for cars. So we do find a number of these companies that have been accumulated such technology over years. So it's really difficult to copy or try to enter that field. You know, so for example, in the portfolio, you know, we have a component maker called Murata. They make these key components in EVs and hybrids, and you know, the content is expected to rise quite sharply with the introduction of greater adoption of EVs. Koito, they make these energy-saving lamps for cars. Also globally, the company Sunken Electric, they make these energy-saving chips, and just by improving the efficiency of how these electric circuits are used, you can save energy by, you know, for example, 30% for air cons just by better controlling the equipment with the chips. So there's a question that when we go to companies, of course, we talk about the potential headwinds in terms of rising carbon costs, but oftentimes you'll find that they're excited. The management team is excited talking about potential opportunities ahead from from energy saving demand, because this is an area that Japanese companies excel in.
One of the things I've been thinking about, Nick, I don't know, we've got the Thomas Lloyd Fund that came along and investing sort of around various bits of Asia, but not really China, Japan, India. Is that the sort of thing you might be interested to look at as a sort of Asian renewable energy fund?
Sorry, Asian Renewable Energy Fund. So certainly we have a reasonable exposure to infrastructure and renewables. They are much more the traditional, the large investment trusts that we have already in the UK. I think that's a little bit more on the niche side. But let's certainly never say never. I would say, I would reflect back across the comments said already. I think, to be honest, where we've seen from an equity point of view that thematically most investment has been in China. So certainly areas of renewables, EV, a number of those sort of themes and sub themes. That's really where I think people are getting most excited. I wouldn't disagree on Japan, by the way. I mean, that's entirely agree with those comments. But I think it's, from a direct equity point of view, it's probably in China that you're getting most of that exposure coming through.
One of the things that puzzles me, I think now, Elizabeth, is that China is almost the largest economy in the world. I mean, it's not far off overtaking the US. Why is it still an emerging market fund?
That's a good question, and I think going forward that might not be the case. I think starting with talks of eventually when A shares are fully included at 100% in the MSCI Emerging Market Index, for instance, maybe that can be taken out, because China will be 53% of the whole index, so it's likely to have a separate allocation. And in terms of why it's still classified as an emerging market, you reference GDP per capita at the start of this panel. I think that was one of the reasons that was cited by MSCI in terms of their official classification. It's not low, but compared to some other Western economies, it's not that high. I think it's because they have such a big population, and if you go to tier 1 cities, Shanghai, Shenzhen, there's no doubt that is not an emerging country. But at the same time, if you go down to tier 4 or 5 cities, it's still relatively underdeveloped in some of those places. And I think that is one of the reasons why there was so much talk of common prosperity last year. The idea of common prosperity, I think, is not to take from the rich and to give to the poor, which is commonly the perception. But I think the government really wants the whole population to get rich together, essentially, to improve GDP per capita. So I think if they're able to do that, then I think that will be one step in moving away from being classified as an emerging market. So I think there are a lot of other factors, but if you look at the demographics, as you say, they're already having signs of an aging population as well, which is uncharacteristic of many emerging markets. So I think going forward, they will probably have to relook that classification.
And actually, I was interested the Japanese sort of official policy seems to be to try and reduce that income inequality as well. So what sort of measures are they taking in Japan to do that?
So Prime Minister Kishida has talked about distribution and sort of supporting the lower income families and so on. And we actually seen that during the towards the end of last year, when the stimulus package was announced. One of the key things that included was support direct payments to families with children, or part-time contract workers that have been affected by COVID, as well as some of these smaller to medium enterprises. But it's not just about distribution. There is the recognition that there needs to be growth, and there are various initiatives by the government to try to make that happen. So one of the things that we've seen is potential introduction of tax incentives for companies that raise wages. That could lead to higher wages across the board, and also that leads to consumption, that leads to capex and so on. So try to induce that positive cycle. So there is that continued effort by the government to try to narrow that inequality.
Thank you. So one of the sort of, not trends, but one of the things that people started talking about more the last couple of years is sort of deglobalization. This idea that, especially here in Europe, that we sort of bring the manufacturing back to Europe and shorten supply chains and make them more resilient. And how important is kind of intra-regional trade, do you think, to the success of Asia? How important is it that whether you can sell into India or into China from Japan and vice versa? And what are the sort of barriers to that? Maybe Hisashi first, please.
Sure. Yes. As you mentioned, I mean, it's a bit of a contrast to what we've seen in the past. This supply chain diversification and so on. Obviously, Japan is quite sensitive to global trade, what's happening around the world, and so on. So we monitor very carefully. But it's not all negative in that what we've seen recently. For example, when you go to talk to semiconductor manufacturing equipment makers, is that so these makers of this high-tech equipment that are needed to make semiconductors, they're actually seeing the rise in demand from these investments around the world, because in the past it was consolidation, now it's diversification, so they suddenly see this demand grow. So it's an opportunity for some of these companies, and it could lead to inefficiencies in the supply chain. But for equipment makers, it's an opportunity, and we actually continue to see that trend. So for example, when we talk to these semiconductor manufacturing equipment companies, they're seeing a rise in demand in China, for example, and semiconductor, for example, has become a matter of national interest. So it's quite a strategic area, and at the same time, it is a risk to manufacturers. We do see hiccups in one part of the supply chain somewhere in the world, and that leads the whole supply chain. But what we're seeing right now is the companies realize that maybe they need to be better prepared. It's not just about consolidation, but it's also about diversification, local production, diversifying procurement or supply sources of supply. And we see that these companies are trying to be more resilient for uncertainties ahead. So yes, it is a bit of a shift from what we've seen in the past, but it's also an opportunity for these makers, for these companies that provide equipment, that provide parts, that provide components. So there's a sort of positives and negatives, I'd say.
And China is quite a big market for Japan. Is India a big market for it as well?
Right now, it's not so large. I mean, if you look at the Japan's exports, for example, US and China is the biggest in the two. They both account for 20%. India, not so much, but we have seen some companies succeed in Japan. I mean, Suzuki, for example, has actually been quite successful in Japan, in India. And in the trust in Japan, investment trust, we actually have a holding called Kansai Paint that provides automotive coatings. So basically, they were successful in Japan. They went overseas with automakers, and they continue to see that growth in India. So it's not as at the moment, it's not as big market for Japanese companies compared to China, for example. Japanese companies are quite successful in China, but it is an area of growth or next growth, and we see some examples at Kansai Paint, for example.
And Elizabeth, I mean, I think some Chinese companies found themselves that they were trying to export it into India or trying to make a market into India, and then India became sort of quite nationalistic and did the sort of made in India policy. Did that actually affect many things that you're invested in?
When it comes to the companies that we're invested in, I wouldn't say that, you know, many of them had pinned their, you know, their hopes too much on exporting to India. I would say that, you know, exports in general for Chinese companies are not, you know, increasingly not so much as important as they were before. So, you know, like what, 2 decades ago, it was known as the world's factory. They were manufacturing to export to the world. These days, if you look at the breakdown of GDP, services is a much bigger part of that, over 50%. And when they manufacture, a lot of it is for domestic use. So I think if you look at the last 4 years, starting with the trade war with the US in 2018, I think these few years have really accelerated the awareness and desire for the government, for the economy to be more self-sufficient. So, you know, not to say that they're not looking, you know, to import or export, but I think in many industries, there's been a real push towards import substitution, self-sufficiency. They put a lot of money into developing semiconductor industry domestically, for example. It's still, you know, lagging behind other countries. So there has been a lot of investment going into that. And then when it comes to the domestic market, you know, they're trying to bring both supply and demand back into China. So, you know, one of the holdings in the investment trust is China Tourism Group. They are a nationwide duty-free license holder. And the idea is that they're trying to bring consumption back into China. So I think, you know, prior to COVID, when travel was, you know, still very open, it was very common for Chinese tourists to go overseas to Europe, for instance, to be buying their luxury goods or even just general shopping. And I think that's obviously not what the government wants to see. They want to see, you know, money that was made in China being spent domestically. So this company is one of the beneficiaries of that. So on the whole, I think, you know, deglobalization is definitely a trend. You know, not so much India specific in terms of, you know, how much business have been affected. But I think generally speaking, you can definitely see that being more self-sufficient is what they're working towards.
Good, thank you. Nick, do you favour sort of funds with large cap exposure or small cap exposure in Asia?
So I'd say most of our managers have tended to have, so they are broadly all cap in nature. You can imagine that there is a reasonable exposure to, or has been, Tencent, Alibaba, Taiwan Semiconductor, certainly. You know, it's quite interesting as the A-share market opens up. You know that you know there are very large companies in that universe. Equally, there are some slightly smaller, you know, slightly more domestic focused names in there as well. And you know, maybe the opportunity, maybe the alpha generation opportunity. You know, there's plenty of opportunity within that market. I mean, not least because that tends to be a slightly less efficient market, the way, you know, some other retail participants and the domestic Chinese managers act. So I think there's opportunity there, but it's you know, our managers, I would say it's across the board. We haven't necessarily gone down the dedicated small cap route. You know, large cap, small cap. The other area might be, you know, some off index areas. So I mean, Vietnam is a country that's often sort of mentioned, and at times it looks very expensive and in terms of valuations, but certainly it's one that gets some attention. Foreign ownership limits are perhaps a little bit of an issue there, but you know, that's an interesting area, and some of those companies are a little bit smaller as well.
Do your funds have sort of exposure to across the market cap spectrum, or do you tend to favour large cap ones? Hisashi first, maybe.
Yes, so as it is an all cap mandate, and you find around 60% of the stocks held are large cap, and small to mid make up about 40%. So we are overweight mid to small caps versus the benchmark. And the reason being, as mentioned just now, you know, we find a lot of inefficiencies, especially if you go down the scale in terms of market cap. just to give you an example, I mean, we participate in this IPO of a company called Kohoku Kogyo last year, a small cap company, and it came to about 12 times PE. But they are the #1 maker in these key components using submarine optical cables, and no one else can make it well, because they make everything from the equipment to the end parts to the raw material. So that integrated supply chain or integrated manufacturing, it's really difficult to copy. And it's just something like that. And that stock basically doubled after the IPO. And you just continue to find these opportunities, and it's really fascinating. So but you do find that the likes of Toyota, Sony in a fund as well. So but we believe that it's that it's that large and sort of the mid to small cap mix that makes an interesting opportunity for us in terms of investing.
And Elizabeth, I know you've got holding in the Aberdeen China A-share fund within Aberdeen China. Is that a way of getting access to smaller companies?
It is, you could say it's a temporary way that we've decided to go with, mainly because we are still setting up the QFI facility for the Aberdeen China Investment Company. So, currently the possible ways of accessing A shares is either via the Stock Connect, which is via Hong Kong, or directly via the QFI. So, there are some stocks that are not yet entered into the Stock Connect program, meaning they can only be accessed via QFI. So while that application is ongoing, we've kept our position in the open-ended China A-share fund. So that does allow us to buy companies, a broader universe of companies, some of which are not stock connected yet. But eventually, once we get the QFI, we will, we'll go direct into those stocks. That applies not just for small cap, but all cap really. But of course, the larger market cap is, the more likely it will be on the Stock Connect program. But generally speaking, that's just a temporary measure that we're planning to phase out once we get the QFI.
Thank you. Then interest rates look like to go up. We also look to get some kind of quantitative tightening as well. Is that a worry for Asian markets? I know in the past it's been a sort of general perception that when US rates go up, emerging markets do badly. I don't know, Asia generally. Is that something that you're concerned about? Maybe Hisashi first, please.
Yeah, so what we have seen is that Bank of Japan has, on the back of some of the decisions seen with the Fed or central banks around the world, Bank of Japan actually decided to maintain the current policy. So what has happened as a result is the sort of the gap between the rates between US and Japan and so on, and so far it hasn't the effect hasn't been as significant. I mean, what we have seen, of course, is like we've seen in markets around the world, a sort of the market favoring value stocks at the expense of some of the growth and quality stocks. But we actually see there's an opportunity, as a growth or as a quality manager. So we're a bit more biased to growth, but we're finding some very attractive opportunities at the moment on the back of broader sell-off. Of course, with this sort of potential going into this cycle of rates hikes, we are conscious about variations, even more so than in the past. But at the same time, we are finding this is an interesting opportunity to sort of revisit some of the stocks we have in the pipeline, or high quality stocks that have fallen along with the market.
Thank you. And Elizabeth, I think China's probably one of the big economies going the other way, that you've actually got slightly easier monetary conditions. So, so how do you think that might change how is that going to impact China relative to the rest of the world, maybe?
Yeah, so you're right. Unlike most of the developed markets or other countries that are raising rates, China's on the other end. We probably more towards the start of an easing cycle. So we saw starting in last December, they lowered the triple R rate for banks. They've cut the loan prime rate and some medium term rates. So in general, I think we should look to expect more liquidity and support from policymakers in the coming months. I think that's very much because last year there was quite a lot of pressure on growth coming firstly from the property slowdown, which is a big part of the economy, and then also regulation that came out. So there was quite a number of factors at play that I think slowed growth down, and obviously growth is still a priority for them. They just mentioned that they have 5.5% GDP growth target. So in order to get there, I think the economy will need a bit of help. So monetary policy is one way to do so, and they've always said that they are adopting an accommodative monetary policy. So I guess this is them being accommodating, and not only on the monetary side but fiscal as well. So in general, I think that's good news. Not so much to worry about. They also don't have as much inflationary pressure to worry about, well, at least until recently. So I think overall it's quite a manageable situation looking for the next couple of months.
And is that property debt problem sorted now, or are we still working our way through it?
So I wouldn't say it's sorted. The size of the debts that we've seen is really quite big, so it would be quite impossible for them to resolve it overnight. I think the government have been quite firm in their stance of wanting to clean this up and not allowing such heavily geared companies to continue. So I think what we've seen over the last month or two is a little more positive in the sense that there's more differentiation between those that they deem as healthy and of good quality private enterprises versus some of the other players that have taken on way too much debt to handle. So those which are in a relatively good state, they've been allowed slightly looser terms in terms of what they're allowed to do. And that bodes well for them in terms of opportunities for consolidation and prospects going forward. But for us, obviously we only stick to those players, especially in this kind of environment. But I think it will be some time to come before the whole thing's really cleaned up.
There's a couple of questions. I think we can't ignore it, but the whole point about Russia and Ukraine. Nick, is that actually changing anything in your portfolios?
Well, the weighting towards Russia is a little bit smaller, shall we say? No, I mean, not especially. We've done an exercise of just being sure we know exactly what we own in regard to Russian exposure. I wouldn't say for at least the various managers that we have, it hasn't been that exposure hasn't been so significant. I mean that as it stands today, either some houses have written this down to zero, or it's a very much less significant proportion. But there are a few Russian stocks which were favourites, perhaps more on the value side. It's commodity based economy, a couple of gold stocks, but it wasn't really playing a major role even in emerging markets. And I said, if you look at emerging markets, 70% Asia, Brazil, Russia, South Africa, I suppose are some of the other ones. But I can't say this has materially sort of moved the needle for us, to be perfectly honest.
And Elizabeth, do you think it's going to have much impact on China generally? Just what's happening? Just the knock-on effects, I suppose, of like commodity rises and that sort of stuff.
Yeah, I think commodity prices would probably be one of the major knock-on effects that we're seeing. So, down the supply chain, there are many industries that are affected by this. Down to consumption, household goods, white goods, air conditioners, refrigerators. Those all require all various different types of commodities. So as we touched on earlier, the key is really whether the companies can go through the cycle, pass on the costs. because inevitably, they will be impacted by higher prices. And I think not only that, but logistical disruption is another area. There are still goods and services that are, being traded, imported, exported. So just have to be a bit more wary of those kind of risks for the companies that we own.
And in terms of sort of China's relationship with Russia, do you think that has any bearing on what you're doing? I
think we're quite careful, and we're watching it closely. I think at the moment we haven't made any drastic changes to our portfolio as a result of the recent events. So I would say so far no, but if things continue to escalate, then we probably need to be a bit more careful.
And anything that Japan is looking at, you think, in the context of this, Hisashi?
Yeah, so generally speaking, we obviously talk to all the companies that we invest in that have Russian or Ukraine exposure, and the conclusion is that it's quite limited, and direct impact is quite limited compared to the global operations. Many of these global companies have operations around the world, but what we are looking right now is the indirect impact, whether from cost increase. Some of these businesses we invest in, they have sizable Europe business, and they rely on things like natural gas and assessing the impact. But what we've heard so far from the companies we invest in is that in fact they are able to, they have these formula in place so they can raise prices in line with the cost inflation. And the other thing we are looking at is sort of the like Elizabeth mentioned, sort of logistical issues, or if this whole cost inflation or geopolitical risk lead to slower growth going forward, and that has implications for many of the stocks we hold because they are global, and so we are assessing that risk as we speak. But again, I think it's what we find in the past crisis like this is that quality companies tend to be more resilient because of the business model, their pricing power, and higher margin, strong balance sheet. So we believe that the management teams, they have the track record of managing these difficult times. So we continue to have trust in them at this time.
And just generally, how do you feel the valuations are now, and how's that influencing gearing at the moment in your funds?
So for us, for Ajit, the gearing, potential gearing range is about 5 to 15%. Right now it's about 10-11%. We don't try to time it because it's quite difficult. But the reason we do have that gearing so that we can make better use of capital and invest in these companies that for which we believe there's a upside and attractive opportunities. So it's actually really a way to fund the opportunities which you think are attractive. But in terms of variations, it has actually fallen a fair bit. I mean, if you look at topics, which is the benchmark for Ajit, it's about 13 times forward PE and 1.2 price to book. So compared to even a historical or variations or compared to peers as well, we believe that it is quite attractive. But I think because of the uncertainties ahead, we believe that we also need to look at the sort of the stock specific basis. And at this point in time, that we actually need to pay a bit more for companies that are able to navigate these difficult times, whether through cost pass-throughs or local production to mitigate some of these supply chain issues, or companies that have strong enough structural growth opportunities, whether in tech or healthcare, that are able to that structural growth opportunity to offset some of the uncertainties ahead.
And Elizabeth, what's your kind of feeling on valuations and gearing?
Yeah, so I would say that, when you look at valuations of China, it is looking relatively attractive. China has lagged, other markets year to date this year. So, with growth, still relatively decent, I think it is looking pretty attractive. In terms of gearing for ACIC, we are in the midst of setting up the gearing facility now. I think a bit of gearing wouldn't be a bad idea at the moment, given where valuations are. But at the same time, it's not without risk, in the sense that things are changing so quickly and quite volatile. So probably a little bit of gearing at this time would be what we would shoot for once the facility is set up.
Thank you. So Nick, maybe you could sum up this. I mean, just are you minded to increase your allocation to Asia at the current time, or are you just sort of maintaining where it is?
No, we haven't been. I mean, quite frankly, it's it feels like it clearly is a pretty volatile environment. I think long term, Asia clearly is an opportunity, but I think we had a good day in the markets yesterday, but I suspect for now it's we'll continue to see some gyration. So I would, on balance, I think in the short term I would be a little bit more conservative, but long term we have a strong view. This will a very interesting place to invest, but it would be nice to see a few of the world events settle down, shall we say.
Okay, fair enough. Well, thank you very much for everybody that tuned in. There are individual presentations from both these managers up on our website, and I'd urge you to go and have a look at those. They explain a bit more about how their funds work and what they're invested in. And thank you all for listening, and we'll be back next week, and Janie will be interviewing some UK managers. So thank you very much. Bye-bye.